U.S. natural gas futures tumbled to an 8-month low on Tuesday, pressured by near-record production, robust storage levels, and forecasts for cooler weather and weaker demand through late August. The bearish tone was further amplified by the looming threat of a storm that could strike the U.S. East Coast next week, potentially curbing demand if it develops into a hurricane. The U.S. National Hurricane Center expects Tropical Storm Erin to intensify into a major hurricane as it tracks westward across the Atlantic toward the Bahamas over the coming week. Analysts note that Atlantic storms often weigh on demand and gas prices by forcing LNG export facilities offline and causing widespread power outages, which in turn reduces LNG feed gas needs and the volume of natural gas burned by power plants to keep electricity flowing. Meanwhile, dry natural gas production continues to hover near record highs, reaching 109.4 billion cubic feet per day on Monday, a 6.3% increase compared to the same period last year. This elevated output underscores the resilience of U.S. supply even as the natural gas rig count edged lower by one last week to 123, just shy of the recent two-year peak. While the slight dip in rigs may suggest a minor slowdown, overall drilling activity remains robust, supported by efficient operations, strong well productivity, and steady investment in key producing regions. This sustained production strength continues to weigh on market sentiment, adding to the bearish pressure on prices. Meteorologists expect temperatures to stay above seasonal norms through at least August 27, though not as hot as earlier projections had indicated. So far in August, gas flows to the 8 major U.S. LNG export facilities have averaged 16.2 billion cubic feet per day, up from 15.5 in July. However, this increase has done little to lift gas prices, as the export strength was largely anticipated and overshadowed by record-high production, which continues to outpace both exports and domestic consumption. Even with a hotter-than-normal summer, the sheer scale of output has enabled energy companies to inject more gas into storage than is typical for this time of year, accelerating inventory builds in recent months. In the near term, the market bias remains firmly bearish after the long-standing $2.88 support gave way. If this Thursday's EIA storage report confirms a hefty 57 billion cubic feet injection, prices could slide further toward the critical $2.50 mark. That said, the outlook isn't entirely bleak. The next 2 or 3 reports are expected to come in notably bullish, and with technical conditions already deep in oversold territory, a rebound seems almost inevitable. The real question is whether such a recovery will have enough momentum to push through the newly established $2.88 resistance, which until recently served as a major support level. I've got to say, I'm genuinely pleased to see my call finally play out. Gas prices have officially broken below the $3 mark, just as I've been predicting for months. Ever since prices spiked to $4 back in June, I've been pretty vocal, sometimes to the irritation of a few critics in the comments, that this rally was driven far more by speculation than by fundamentals. I kept repeating that if you strip away the hype and look purely at the supply-demand balance, the realistic fair value for gas sits right around $3. Now, with this drop, the market is finally catching up to reality, and I can't help but feel a bit of vindication seeing it unfold exactly as expected. Don't forget to like, drop a comment, and check out the previous video to help support the channel. See you in the next one.